Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Mark Phillips, CEO of Harvested Financial, with his 2021 outlook on the options market, passive versus active management, and we'll talk some sector rotation as well. Mark, it's great to see you as always. Welcome back to Trade Talks.
Yeah, thanks, Jill. It's good to see you here again.
Active management has crept back into the spotlight with the market volatility in 2020. Do you think passive flows will prove to be resilient?
Yeah, that's a really interesting question, Jill. And I think that's been a debate for several years now, is that what is the overall structural impact of a lot of these passive flows? And I think we've seen the assets under management in passive funds really start to grow. And many of the questions being posed about that, we're asking, what is the impact on the market here? Passive flows are sort of characterized as being price blind and buying at any sort of level. But I think this year really demonstrates many of the benefits of that and what dollar cost averaging and sort of that systematic exposure can do for some of these passive investors. So to the extent that they were able to buy through February, March, April lows there, I think that's put like a lot of resiliency behind that method. And I think we're going to see a lot of continuation of that sort of allocation to these passive methods, dollar cost averaging into the low fee sort of diversified ETFs. And I think they've been vindicated by this year and the rebound from buying the dip here.
Tell us about structural volatility selling returns. That's a new term for the Trade Talks audience.
Yeah, absolutely. So I think, in many ways, the same sort of market action that is proving resilient for those passive flows really burned some of the volatility sellers this year. So, of course, we know that when the market tends to go down, volatility really tends to spike up right there. So some of the systematic sort of volatility sellers come from a number of different places. They could come from a structured product-like vehicle. There are some sort of multi-strategy hedge funds that provide this type of exposure. But there's a lot of sort of systematic volatility selling also because of its ability to capture yield premium. And so in an environment where we're seeing bonds with very low rates, investors are looking for other alternatives, and they often go towards the options markets to sell, volatility premium and provide sort of that supply to the implied volatility out there in the market. Well, when that number goes up, they tend to see some big losses, and they, after you've been burned a little bit, they tend to peel back. However, I think we're going to see a return of them in 2021. A lot of the reason being that sort of low yield environment that we're in, investors are chasing a lot of that alternative yield. And I think another interesting factor here is that as we actually see this oversupply of volatility, that's putting pressure on some of the volatility indices, which has a reflexive effect on some of the other market participants. So to the effect that, or to the degree that there are risk parity funds that are benchmarking their equity allocations based on overall volatility levels in the market, they tend to allocate more towards equities as that volatility comes in. Volatility comes in, the winners of vol selling win, and so we really see this sort of recursive effect from a lot of these players. So I expect to see some of that dynamic continue because it's very much baked into the market and the mandate of a lot of these market participants.
2020 also proved to be a stellar year for options volume as more retail traders entered the market. Do you expect to see more growth in 2021?
Absolutely. Not only has 2020 been completely bananas in terms of options volume, it's only accelerated as the year's gone on. So I think looking at some of the annualized numbers, I believe the OCC volumes are up something like 50% this year. The average daily volume is something like 29 million contracts. Now, November was up 70%. And already in December, we're seeing an average of in the mid 30 million contracts a day. So that trend has continued to escalate. And so the volume numbers are up there. And in a lot of ways, it's the composition of the volume numbers that I think makes a really interesting outlook for 2021 here. Being that so many of these new participants in the market are these retail traders, that does have a little bit of a structural impact on the market. What names they're going for necessarily, and sort of how the dealers and market makers are responding to these types of flows. It's been really interesting because I think we hear the name retail and think these are 1 and 2 lots, and there are plenty of those. There are hundreds and thousands of those 1s and 2 lots out there. But we're also seeing some sizable players out there. So it's not just your small type retail activity that's typically characterized by that. These are some volumes and trade sizes that have the potential to really move the market. And so, to the extent that there's a lot of retail volume that's well aligned and moving in the same direction, that creates some questions for dealers as they kind of deal with position concentration and overall adjusting their risk books to house a lot more than they were managing in the past here. One of the additional factors that we might see in some of these retail names as that popularity grows, something we talked about in the index names that's fairly common is sort of the tail wagging the dog effect, where to the extent that options dealers are positioned in certain ways, I think we're going to start seeing that more and more in some of these individual names, to the extent that we get some relatively concentrated positions in some of those single names out there. So a lot of really interesting kind of evolutions as these volume surges happen, and all the different participants adjust to how to price and warehouse this risk.
And you actually answered my follow-up question. It sounded like that there was a lot of single stock concentration option contracts that are out there, and that definitely answered my question. So, Mark, finally, where do you see sector rotation? Is it finally time to look at that growth versus value trade? And is it just that? Is it a trade or a longer-term trend?
Yeah, that's a really interesting question. I think, both that rotation as well as sort of the trickling down to individual names, I really think is something that's going to continue throughout 2021. That growth value trade has seen some momentum over the last couple months, and I would expect that to continue a little bit, to the extent that we've seen some of this massive appreciation in some of the mega growth names. Allocators are looking at price and wondering, how sustainable this is. Their overall concentration in some of those indices is posing some questions for people. But when we think about some of those volatility effects and how that might percolate out to individual names, that volatility suppression at the index level has a way of trickling down to the individual names, in that while the average might be lower and lower and have that supply effect, individual names are actually getting more tightly coiled and might see some bigger moves themselves. So when you think about the selling at the index level percolating down to those individual names, I think that really opens some opportunities to tactically play individual names in some very interesting ways. And the growth value trade, I think, could be a trade or it could be an investment. I think there are some legislative headwinds there. A lot of the Section 230 discussion is providing some potential headwind for some of these growth companies, but we don't really know how that's going to play out. So, I think it's worth keeping an eye on how that continues to evolve over time.
All right, Mark, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.